Welcome to InvestorWeb, the finest source for clear, comprehensive investment and financial insights. We're here to guide you through the maze of finance, to help you navigate the ocean of opportunities, and to clear the fog of uncertainty that often surrounds these topics. Our commitment is to provide you with valuable knowledge that empowers you to make informed decisions. Today we're turning our focus towards a fundamental concept in finance: the 5 C's of credit. This is a critical topic for anyone who wants to understand how lenders evaluate potential borrowers. It's about character, capacity, capital, conditions, and collateral, each one a pillar that supports the decision-making process of lenders. So, whether you're a seasoned investor or just starting out, this is a topic that can equip you with the knowledge to better comprehend the dynamics of credit. Stay tuned as we delve into the world of credit and learn about the 5 C's that are crucial to understanding it. Dive into the first C of credit: character. When we talk about character in the context of credit, we're not referring to your charming personality or your ability to make people laugh. In the financial world, character represents your creditworthiness, your reliability as a borrower, and how likely you are to repay a loan. Let's break this down a bit. Firstly, character can be measured by your credit history. This is a record of how you've managed past debts. It's like a report card for your financial behavior. Have you paid your bills on time? Have you ever defaulted on a loan? These are questions that your credit history can answer. Imagine a friend asking you for a loan. If they've borrowed from you before and returned the money promptly, you're more likely to lend to them again. Your friend's past behavior indicates their character and their likely future actions. Secondly, character is also reflected in your repayment patterns. Do you make minimum payments? Do you pay off your debts as soon as possible? Lenders look at these patterns to assess your commitment to meeting your financial obligations. Finally, your personal reputation also plays a part. This may seem subjective, but in business, reputation is everything. It's about trustworthiness, integrity, and willingness to meet obligations. Your professional standing, your employment stability, even your personal references can all contribute to your character as a borrower. Now let's consider a real-life scenario. Suppose you're a lender and you have 2 potential borrowers. Borrower A has a perfect repayment record, a steady job for the last 10 years, and glowing references. Borrower B, on the other hand, has missed several payments in the past, changes jobs frequently, and has no references. Who would you lend to? Most likely borrower A, because their character indicates a lower risk. In essence, character is a critical component of credit analysis. It's your financial fingerprint, unique to you, and can make or break your ability to obtain credit. Understanding a borrower's character can significantly impact a lender's decision to extend credit. Discover the second C of credit: capacity. As we navigate the world of credit, we come across capacity, a crucial component in the lending decision process. But what exactly does it mean? In simplest terms, capacity refers to a borrower's ability to repay a loan. It is a measure of your financial strength, an indication of whether you can manage the loan repayment. Let's delve a little deeper, shall we? When assessing capacity, lenders look at several factors. Top of the list is your income. A steady, sufficient income demonstrates that you can comfortably meet your loan obligations. But it's not just about how much you earn, it's also about the stability of your employment. A long-term, stable job is a positive sign, as it indicates a reliable source of income. Now, you may be wondering, I have a good income and a stable job. Does that guarantee I will get the loan? Well, not quite. There's another crucial factor to consider: your debt-to-income ratio. This is the proportion of your income that goes towards paying debts. If you're spending a substantial part of your income on debt repayment, it could raise red flags for lenders, as it may imply that you're overextended and may struggle to manage additional debt. Let's illustrate this with an example. Imagine you're a software engineer earning a fabulous salary. You've been with your company for 5 years. So far, so good. However, you're also paying off a mortgage, a car loan, and a couple of credit cards. If these debts are consuming a large chunk of your income, lenders might be hesitant to extend additional credit to you despite your high income and stable job. In essence, capacity is all about balance. It's about demonstrating that you have a steady income, a stable job, and a manageable debt-to-income ratio. It's about showing lenders that you can handle the loan and meet your repayment obligations without straining your finances. Assessing capacity helps lenders determine if borrowers can manage the loan repayment. It's a vital piece of the credit puzzle, helping paint a clear picture of your financial health. So remember, when it comes to credit, capacity counts. Uncover the third C of credit, capital. In the realm of finance, capital refers to the wealth in the form of money or other assets owned by an individual or organization. It's the financial ammunition that fuels investment, business operations, and of course, loan repayment. But how does capital relate to credit? Well, when you approach a lender for a loan, they're interested in two main things: your ability to repay the loan, which we covered under capacity, and your financial resources or assets. These assets form your capital. Imagine you're a lender. Two individuals approach you for a loan, both have the same income, but one has substantial savings and investments while the other has none. Who would you consider less risky? Naturally, the individual with the assets, as they have a safety net of sorts. This safety net is their capital. Your capital could consist of savings, investments, property, or other significant assets. It's a representation of your net worth. Lenders use this information to evaluate how much risk they're taking on by lending to you. If you have substantial capital, lenders see you as a lower risk because you have assets that can be used to repay the loan if your income were to suddenly stop. For instance, let's say you're an entrepreneur seeking a business loan. The lender would consider the capital you've invested in your business. A reasonable amount of your own money invested into the business demonstrates that you have skin in the game, which reduces the lender's risk. But remember, while having substantial capital can enhance your creditworthiness, it's not a silver bullet. Lenders consider all 5 C's of credit, including character and capacity, which we've covered, and conditions and collateral, which we'll delve into next. Evaluating capital gives lenders insight into a borrower's financial health. It's an essential piece of the credit puzzle, helping lenders paint a holistic picture of your financial situation. As a borrower, understanding this can help you better prepare when seeking credit, so keep your capital in mind when you're planning your financial future. Explore the 4th C of credit, conditions. Now let's delve into the concept of conditions, the 4th C of credit. Conditions refer to the external and internal factors that could influence a lender's decision to provide credit. These can range from the purpose of the loan to the prevailing economic climate. Let's start with the purpose of the loan. The reason why you are seeking credit could significantly influence a lender's decision. For example, if you're applying for a loan to start a new business, the lender may consider this riskier than if you were applying for a mortgage, given that new businesses often face unpredictable challenges. Now think about market conditions. The state of the economy can dramatically affect a lender's willingness to extend credit. In times of economic prosperity, lenders may be more inclined to take on riskier loans. However, during economic downturns, they may tighten their lending standards, making it harder to obtain credit. Furthermore, lenders may also consider industry-specific conditions. Let's say you are in the hospitality sector and there's a global pandemic affecting travel. Lenders may view loans to businesses in this sector as higher risk due to the current market conditions. Understanding how these factors interplay is crucial in comprehending how lenders make their decisions. By grasping the concept of conditions, you equip yourself with the knowledge to better navigate the lending landscape. Understanding conditions helps lenders gauge the level of risk involved in a loan. Unearth the 5th C of credit, collateral. This is the security blanket for lenders, the safety net that catches them if a borrower defaults on a loan. But what does collateral look like? It can take many forms, from real estate properties and vehicles to stocks and bonds. It's the tangible or intangible asset that a borrower pledges to ensure repayment of their loan. Imagine this. You seek a loan to start a bakery. Your lender might consider your personal home or your car as collateral. If your bakery fails to rise to the occasion and you default on the loan, the lender can claim your pledged assets to recoup their losses. Collateral can be a powerful tool in securing a loan, but it also carries risks for the borrower. It's a high-stakes game of trust. Remember, the value of your collateral is always under the lender's microscope. Assessing collateral provides lenders with a safety net in case of loan default. Now, you have a solid understanding of the 5 C's of credit. We've explored character, your trustworthiness and reliability; capacity, your ability to repay the loan; capital, the resources you have invested in your endeavor; conditions, the external factors affecting your ability to pay; and finally, collateral, the security you provide for the loan. These are the pillars of credit assessment, crucial for both lenders and borrowers. Thank you for tuning in to Investor Web. Don't forget to subscribe for more financial insights. Until next time, keep investing wisely.